the illusion of stability. Imagine a high-rise building. From the outside, it looks majestic, solid, and eternal. The windows reflect the sun, and the lobby is filled with people in expensive suits. This building is our global financial system. But what most people don't see is that the foundation was built on shifting sand. Every floor added to this skyscraper is a new layer of debt. And right now, the ground underneath is starting to shake. Welcome to a deep dive into the architecture of wealth. In the next hour, we are going to perform a financial forensic analysis of the world economy. We are going to look past the marketing slogans of Wall Street and the headlines of the mainstream media to see the raw mathematical reality of our time. If you are watching this, you probably feel that something is not right. You see the prices at the grocery store rising every week. You see the national debt reaching numbers that the human brain can barely comprehend. You see the middle class shrinking while the gap between the ultra-wealthy and the rest of the world turns into a canyon. This is not a coincidence. This is the result of a specific economic design. To understand where we are going, we first have to understand the product we use every single day: money. But here is the secret that the banking industry doesn't want you to focus on. Modern money is not a store of value. Modern money is a marketing masterpiece. It is an illusion maintained by the belief that tomorrow will be exactly like today. Let's start with the hard truth. Most of what you were taught about financial security is a lie designed to keep you inside a system that harvests your productivity. You were told to work hard, save money in a bank, and invest in a diversified 60-40 portfolio of stocks and bonds. This was great advice in 1995. In 2026, this is a recipe for financial suicide. Why? Because the rules of the game have changed. Since 1971, when the last link between the US dollar and gold was severed, we have lived in a world of pure fiat. Fiat is a Latin word meaning "let it be done." It means money exists only because the government says it exists. It is backed by nothing but a promise. And as any marketing expert will tell you, a promise is only as good as the reputation of the person making it. Right now, the reputation of global currencies is at an all-time low. We are witnessing a silent theft. This theft is called inflation, but calling it inflation is a marketing trick in itself. Inflation sounds like a natural weather event, like rain or wind. It isn't. It is a deliberate debasement of your life energy. When a central bank prints $1 trillion, they aren't creating wealth. They are simply diluting the value of the dollars already in your pocket. If you have $100,000 in a savings account and the money supply grows by 10%, you didn't lose any physical bills, but your ability to buy land, food, or energy just dropped by 10%. You were taxed without a vote. You were robbed without a weapon. This brings us to the first pillar of our analysis, the debt cycle. In economics, debt is like a drug. In small doses, it can stimulate growth. It allows a business to expand or a family to buy a home. But when the amount of this drug is too high, the body becomes dependent on it. Today, the global economy is a debt addict. The total global debt is now over $300 trillion. To put that in perspective, that is more than 3 times the size of the entire world's annual economic output. It is mathematically impossible to pay this debt back with money that has actual value. There are only two ways this ends: either a massive, painful default that wipes out the banking system, or the slow, agonizing destruction of the currency through hyperinflation. But wait, if the situation is this dire, why isn't everyone panicking? Why is the stock market still near all-time highs? This is where marketing meets finance. The financial industry is the most sophisticated marketing machine ever built. Its goal is to maintain confidence. As long as you believe the dollar is safe, you will keep working for it. As long as you believe the stock market always goes up in the long run, you will keep your 401k invested. The moment that confidence breaks, the building collapses. In this video, we are going to look at the cracks in the foundation. We are going to examine the 5 stages of currency collapse and identify exactly where we are in that cycle. We will look at why traditional investing is failing and how a new class of anti-fragile assets is emerging to take its place. We will talk about marketing, not just how to sell products, but how the world's most powerful institutions sell you a version of reality that keeps you poor. We will talk about economics, not the dry formulas you learn in college, but the street-level economics of survival and power. And finally, we will talk about investment, the specific moves you need to make to ensure that when the reset happens, you are on the side of the winners. This is not a video about getting rich quick. This is a video about staying wealthy forever. It is about understanding the forensics of the system so you can build your own architecture of wealth. So grab a notebook, turn off your notifications. If you want to protect your family and your future, you need to understand the mechanics of what is coming. Because in the age of chaos, the greatest risk is not taking a risk. The greatest risk is remaining ignorant of the patterns that have destroyed every empire in human history. Let's begin the autopsy of the modern financial system, the economic autopsy. To understand the future of your bank account, we have to travel back to a time when money actually meant something. We need to distinguish between two terms that people often use interchangeably but are fundamentally different: currency and money. Most people think they have money in their pockets. They don't. They have currency. Money is a store of value that maintains its purchasing power over long periods of time. Gold is money. Silver is money. Land is money. Currency, on the other hand, is a medium of exchange that a government tells you to use. It is a tool for transactions, but it is not designed to hold value. In fact, it is designed to leak value. For thousands of years, humans experimented with different forms of money. We used salt, seashells, and cattle. Eventually, we settled on precious metals because they were scarce, durable, and impossible to fake. You couldn't just print more gold. You had to dig it out of the ground with sweat and blood. This created a natural limit on how much a king or a government could spend. If a king wanted to go to war, he had to have the gold in his treasury or tax his people to get it. He couldn't just create it out of thin air. This forced governments to be fiscally responsible. But then came the 20th century, and the rules started to change. After World War II, the world's leading economies met at a place called Bretton Woods. They agreed that the US dollar would be the world's reserve currency, and the dollar would be backed by gold at a fixed rate of $35 per ounce. For a few decades, this system worked. The world had a stable anchor. But as the United States started spending heavily on the Vietnam War and massive social programs, foreign nations began to notice something. The U.S. was printing more dollars than they had gold to back them up. Countries like France started getting nervous. They began sending their dollars back to the US and demanding their gold in return. It was a classic bank run on a global scale. The US Treasury was being emptied. On August 15, 1971, the world changed forever. President Richard Nixon went on national television on a Sunday evening. He didn't say the country was broke. Instead, he used a brilliant marketing strategy. He told the public that he was temporarily suspending the convertibility of the dollar into gold to protect the dollar from speculators. This was the greatest marketing pivot in human history. In one night, the dollar went from being a receipt for gold to being a piece of paper backed by nothing but the full faith and credit of the United States government. The temporary suspension is still in effect 55 years later. This event, known as the Nixon Shock, turned the entire global economy into a massive experiment in fiat currency. Without the golden anchor, there was no longer a limit on how much money could be created. This brings us to a concept in economics that every investor must understand: the Cantillon effect. Named after the 18th century economist Richard Cantillon, this principle explains why money printing always benefits the rich and hurts the poor. When a central bank creates new money, that money doesn't enter the economy evenly. It goes to the big banks and the government first. They get to spend that new money at today's prices before the rest of the market realizes there is more currency in circulation. By the time that money trickles down to you, the nurse, the teacher, the small business owner, prices have already risen to account for the new supply. The people closest to the printing press get the value, while the people furthest away pay the price through inflation. It is a silent, invisible tax that transfers wealth from the bottom to the top. But how did they convince the public to accept this? This is where the marketing of debt comes in. Before 1971, debt was generally seen as a burden. You saved up to buy a car. You worked for years to pay off your mortgage. But in the new fiat era, the system needed people to borrow more money to keep the wheels turning. If everyone stopped borrowing, the money supply would collapse. So, the marketing changed. Debt was rebranded as credit, and credit was marketed as freedom. Suddenly, you didn't need to wait 10 years to start a business or buy a house. You could have it now. The credit card industry exploded. Banks started measuring your worth not by how much you owned, but by your credit score, which is essentially a measure of how good you are at being a debtor. We moved from a society of owners to a society of renters. We rent our homes from the bank through 30-year mortgages. We rent our cars through leases. We even rent our software and our entertainment through monthly subscriptions. This shift has profound implications for your investment strategy. In a world of infinite currency, any asset that can be printed or digitalized will eventually lose value. This is why saving is now a losing game. If you put $100 in a savings account in 1970, it had the purchasing power of roughly $800 in today's money. If you held that same $100 in a box under your bed, you lost nearly 90% of your wealth without ever making a bad investment. You were just holding the wrong product. Investors who understand this forensic reality don't look for yield in savings accounts. They look for scarcity. They look for things the government cannot print. This is why we see the rise of alternative assets. It is a rational response to a marketing lie. The world is waking up to the fact that the dollar is no longer a safe haven. It is a melting ice cube. Another layer of this economic autopsy is the petrodollar system. In the mid-1970s, the U.S. made a deal with Saudi Arabia. The U.S. would provide military protection, and in exchange, Saudi Arabia would price all of its oil in U.S. dollars. This created a constant, global demand for the dollar. Every country in the world needed dollars just to buy energy to run their factories and heat their homes. This gave the U.S. a superpower status. It allowed the U.S. to export its inflation to the rest of the world. But today, that marketing agreement is cracking. Countries like China, Russia, and even Saudi Arabia are starting to trade oil in other currencies. The global demand for the dollar is shrinking. When the demand for a product drops, but the supply keeps increasing, the price must crash. This is basic economics. We are approaching the end of a 50-year cycle. History tells us that fiat currencies have an average lifespan of 27 years. We are currently at double that average. The system is stretched to its absolute limit. So, as an investor and a business owner, you have to ask yourself, are you building your future on the marketing of the past or the forensic reality of the present? Are you holding currency that is designed to lose value or money that is designed to survive? In the next section, we are going to look at the psychology of the market. We will explore how marketing and social media create bubbles, and why most people are programmed to buy at the top and sell at the bottom. Understanding the history of the system is only half the battle. You also have to understand the software running inside your own head. The psychology of the crash. We have dissected the system. We have looked at the history of the dollar and the forensics of debt. But now, we have to look at something even more dangerous. The software running inside your own head. Because you can have all the historical knowledge in the world, but if you don't understand your own psychology, the market will eat you alive. In the world of marketing, there is a saying, people don't buy products, they buy better versions of themselves. In the world of finance, this is amplified 1,000 times. People don't just buy stocks or crypto. They buy the dream of freedom, the hope of early retirement, and the fear of being left behind while their neighbor gets rich. This is where marketing meets the primal brain. Our brains were not designed for the stock market. They were designed for the savannah. Evolution programmed us with two primary drivers, survival and social status. In a tribal environment, following the crowd was a survival mechanism. If everyone was running in one direction, you didn't stop to ask for a fundamental analysis of a threat. You ran. This is what we call the herd mentality. In a financial context, this instinct is a death sentence for your wealth. The financial industry uses the most advanced marketing techniques in the world to trigger these primal instincts. The most powerful of these is FOMO, the fear of missing out. FOMO is not an accident. It is a manufactured psychological state. It is the result of social proof, a marketing principle which states that people will conform to the actions of others under the assumption that those actions are reflective of the correct behavior. When you see a headline about a teenager making millions on a meme coin or a finfluencer on social media showing off a private jet paid for by a specific trading strategy, your brain experiences a dopamine hit. You feel that everyone else is at the party and you are standing outside in the cold. This is the stealth phase of a bubble transitioning into the mania phase. Every major crash in history, from the tulip mania of the 1630s to the dot-com crash of 2000 and the great financial crisis of 2008, follows the exact same psychological curve. It begins with smart money, investors who understand the forensics and see value before anyone else.
Then comes the institutional phase, where the big banks join in. Finally, we reach the retail phase. This is when the marketing machine goes into overdrive. This is the point where your Uber driver gives you stock tips. This is when your grandmother asks you how to buy Bitcoin. This is when the media coverage becomes 24/7.
In marketing terms, the product has reached mass adoption, but in financial terms, this is usually the exit window for the smart money. They use the massive demand from the late-coming public to sell their positions at the top. Why do we fall for it every time? Because of a cognitive bias called recency bias. Our brains tend to believe that what happened in the recent past will continue to happen in the future. If the market has gone up for 10 years, we find it impossible to imagine a world where it goes down by 50% in a single week. We mistake a bull market for our own genius. As the saying goes, everyone is a professional trader when the Fed is printing money. But let's look at the modern era, where marketing has taken a new, more dangerous form: the gamification of finance. In the last 5 years, we have seen the rise of trading apps that look and feel like mobile games. They use bright colors, digital confetti, and push notifications to trigger a gambling response in the user. This is a deliberate marketing strategy to increase engagement. But in finance, high engagement usually leads to overtrading, and overtrading is the fastest way to drain a portfolio. The industry doesn't want you to buy and hold a boring, productive asset. They want you to trade. They want you to move your money back and forth because every trade generates a fee or payment for order flow. They have marketed the idea that anyone can be a day trader. They sell you the tools, but they don't tell you that you are playing against supercomputers located feet away from the exchange, running algorithms that can execute thousands of trades in the time it takes you to blink. Social media has added high-octane fuel to this fire. We now live in an era of viral finance. A single tweet from a celebrity or a coordinated movement on a message board can move billions of dollars in hours. This is the ultimate expression of the herd mentality. It creates massive volatility, which the marketing machine labels as opportunity. But for most people, it is a trap. There is another psychological trap we must perform an autopsy on: loss aversion. Psychologically, the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. This is why most investors do the exact opposite of what they should do. When the market starts to dip, they freeze. They hope it will come back. They hold on to a losing position until the pain becomes unbearable, usually at the very bottom. Then they panic and sell just as the smart money is starting to buy again. They buy high because of FOMO, and they sell low because of loss aversion. They are the victims of their own biology, manipulated by a marketing machine that profits from their emotions. So how do the financial architects stay sane? How do they avoid the herd? They use a concept called inversion. Instead of asking, "How do I make a lot of money?" they ask, "How do I avoid losing everything?" They recognize that the marketing reality is almost always the opposite of the forensic reality. When the media is screaming that the world is ending, they look for value. When the media is celebrating a new era of prosperity, they look for the exit. They understand that profit is not just about the numbers in your account. Profit is the reward for being patient, while everyone else is being emotional. It is the reward for being rational when the marketing machine is trying to make you hysterical. If you want to build an unbreakable portfolio, you have to start by auditing your own information diet.
Are you following trends, or are you looking at patterns? Are you listening to influencers who get paid for clicks, or are you studying the forensics of historical collapses? Marketing tells you that this time is different. Forensics tells you that this time is exactly like 1929, 1971, and 2008. The technology changes, the marketing slogans change, the names of the assets change. But human psychology remains exactly the same. Fear and greed are the two constants of the financial universe. In the next section, we are going to get practical. Now that we understand the system, the history, and the psychology, we are going to build the anti-fragile portfolio. We will look at the specific 5 assets that survived the Weimar Republic, Venezuela, and Zimbabwe. We will look at how to allocate your capital so that you don't just survive the next crash, but you thrive because of it. The anti-fragile portfolio. We have performed the autopsy on the past. We have diagnosed the psychological traps of the present. Now we build for the future. Most financial advisors talk about diversification. They tell you to own a little bit of everything so that if one thing goes down, the others protect you. But in a systemic currency collapse, traditional diversification is a myth. In 2008 and again in 2020, almost every traditional asset class, stocks, bonds, and real estate, fell at the exact same time. This is because they were all tied to the same foundation, the supply of credit. To survive a reset, you don't need diversification, you need anti-fragility. You need assets that live outside the traditional banking system, assets that do not rely on a government's promise or a central bank's printing press. Through our economic forensics of Germany, Venezuela, and Lebanon, we have identified 5 specific pillars of an unbreakable portfolio. Pillar 1, physical scarcity, gold and silver. The first pillar is the ultimate insurance policy. Gold is the only financial asset that is not someone else's liability. If you own a bond, you are relying on the government to pay you back. If you have money in a bank, you are a creditor to that bank. If the bank fails, your money disappears. But gold is a Tier 1 asset. It has no counterparty risk. In every hyperinflationary event in history, gold did not go up in price. Rather, the currency fell down against gold. An ounce of gold bought a high-quality suit in 1920, and it buys a high-quality suit today. It is a constant. The marketing machine of Wall Street tries to tell you that gold is a pet rock or a relic of the past because they cannot charge you management fees on a gold bar hidden in your safe. They want you in products they can control. But the forensics show that when the rules of money are rewritten, gold is the only language every nation still speaks. Pillar 2 is foreign hard currencies and jurisdictional diversification. The second pillar is about escape valves. As we saw in the Lebanon autopsy, the people who were wiped out were the ones who kept all their wealth in the local currency within the local banking system. The survivors were those who held hard currencies like the Swiss franc, the Singapore dollar, or even the US dollar if they lived outside the US. But it is not just about what currency you hold, it's about where you hold it. This is jurisdictional diversification. If all your assets are in one country, you are 100% vulnerable to that country's laws, taxes, and potential wealth seizures. An anti-fragile investor looks to keep a portion of their wealth in a safe haven jurisdiction, a place with a history of property rights and rule of law. You are not trying to hide. You are trying to ensure that a single political decision in your home country cannot reduce your net worth to zero. Pillar 3. Productive equities. Ownership in the real economy. Many people fear that a stock market crash means total destruction.
But forensics show that productive equities, shares in companies that produce essential goods and services, are actually an inflation hedge.
Think about it. If the currency loses half its value, a company that makes bread or provides electricity will simply double its prices. Their profit margins stay the same in real terms. The key here is productive. You want to avoid companies with massive debt or those that rely on discretionary spending, things people can stop buying when times get tough. You want companies that have pricing power, the ability to raise prices without losing customers. These companies act as a bridge across the inflationary gap. They own the factories, the patents, and the distribution networks. These are physical realities that paper currency cannot destroy. Pillar 4. Consumables and barter liquidity. This is the most overlooked part of wealth architecture because it isn't glamorous. It doesn't show up on a flashy banking app. This pillar is about tactical liquidity. In the early stages of a system reset, the banking system often freezes, ATMs go dark, credit cards are declined. In this environment, wealth is not a number on a screen. Wealth is what you have in your pantry and your garage. Forensics from the collapse of the Soviet Union and modern Venezuela show that items like fuel, medicine, tools, and storable food become the new medium of exchange. This is not prepping for the end of the world. This is prudence for the transition of a system. Having 90 days of essentials allows you to stay calm while the rest of the world panics. It prevents you from being forced to sell your gold or your stocks at the bottom just to buy food. Pillar 5. Productive land and real estate. The final pillar is the oldest form of wealth, land. But not just any land. We're talking about productive land, soil that can grow food, or property that provides essential shelter. In a world where the population is growing, but the amount of arable land is shrinking, the forensics are clear. Land is the ultimate finite asset. Unlike a stock or a bond, land cannot go to zero. It cannot be deleted by a computer error. However, land has a weakness. It is immobile. You cannot move it if the political climate turns toxic. Therefore, the strategy for land must be combined with Pillar 2. You want land in a jurisdiction that respects private property. Land provides the base layer of your survival, water, food, and shelter. The marketing of the new wealth. As we build this portfolio, the marketing machine will try to distract you with the next big thing. Whether it is a new digital token, a complex derivative, or a high-yield opportunity in a developing market, you must apply the forensic filter. Ask yourself, does this asset have counterparty risk? Can it be printed into infinity? Does it provide a basic human need? The goal of an anti-fragile portfolio is not to beat the market. The goal is to be the market. By owning the essentials of life, energy, food, land, and hard money, you become the person that everyone else has to trade with when their paper currency fails. You stop being a consumer of the system and start being an architect of your own economy. The blueprint and the conclusion. We have performed the autopsy on the past, diagnosed the psychological traps of the present, and identified the 5 pillars of an unbreakable portfolio. But knowledge without action is merely a distraction. In this final section, we are going to build your personal blueprint. If you were starting today with a blank slate, how do you move from a vulnerable fiat-based position to an anti-fragile forensic-proof architecture? This is not a weekend project. This is a fundamental shift in how you relate to the concept of value. Step 1.
the immediate audit. Before you buy a single ounce of gold or a single share of a company, you must perform a forensic audit of your current life. Look at your balance sheet. How much of your wealth exists only as a digital promise in a single banking system? How much of your income is dependent on a single currency?
The first move is to eliminate high-interest debt. In an inflationary environment, debt can sometimes be a tool, but consumer debt, credit cards, car loans, and high-interest personal loans is a parasite. It is a marketing trap that keeps you in a state of constant survival. You should pay off all consumer debt before you invest in anything else. You cannot build a skyscraper on a foundation of quicksand. Clear the deck. Reduce your overhead. The lower your burn rate, the more anti-fragile you become. Step 2. Build the tactical buffer. The forensics of every collapse show that the first 30 to 90 days are the most chaotic. This is when the marketing of order fails and the reality of scarcity takes over. Your goal is to be system independent for at least 3 months. This means holding a tactical amount of physical cash in both your local currency and a stable foreign currency outside of the bank. This is your liquidity insurance. Combine this with your Pillar 4 assets, consumables. If the supermarket shelves are empty for 2 weeks, do you have the calories and the medicine to keep your family calm? This buffer is what allows you to make rational decisions while others are making desperate ones. Step 3. The core preservation layer. Once your survival is secured, you move to wealth preservation. This is where you acquire your insurance policy, physical gold and silver. Notice the word physical. In the digital age, the marketing machine sells paper gold, ETFs, and futures. But forensics show that in a true systemic reset, paper promises are often settled in worthless currency, not the metal itself. Aim to have 5 to 10% of your total net worth in assets that you can physically touch and move. This is your go bag for your wealth. It is the only asset that has never gone to zero in 5,000 years. It doesn't need to pay a dividend. Its job is to be there when everything else isn't. Step 4. Pivot to productive ownership. Now we move from defense to offense. You need your money to work for you in the real economy. This means investing in Pillar 3, productive equities. Instead of gambling on the hottest tech stock or the latest marketing trend, look for value. Look for companies that provide the boring essentials. Think of companies that manage the power grid, companies that process food, or companies that hold massive amounts of productive land. Look for global revenue. If you live in a country with a weakening currency, you want to own companies that earn their profits in stronger currencies. This turns you into a global citizen of the economy, regardless of what happens to your local central bank. Step 5. The intellectual asset. This is the most important part of the blueprint, yet it doesn't cost a penny. The ultimate anti-fragile asset is your own human capital. In a collapse, your house can be taxed, your gold can be hidden, but your skills, your knowledge, and your relationships cannot be confiscated. The marketing machine wants you to be a passive consumer. A financial architect is an active producer. Learn a skill that is indispensable. Whether it is engineering, medicine, marketing, or the ability to navigate complex systems, your value is determined by the problems you can solve for others. In the ruins of the Weimar Republic, the people who thrived were the ones who could fix things, build things, and lead people. The conclusion. The choice is yours. We are living at the end of a grand economic experiment. Since 1971, the world has been running on a system of pure faith. Faith in politicians, faith in central bankers, and faith in a mathematical impossibility. History is a relentless teacher. It doesn't care about our political opinions, our hopes, or the marketing slogans we choose to believe. It only cares about the patterns. The pattern of the last 100 years is clear. Currencies fail.
Systems reset, and wealth is never truly destroyed. It is simply transferred. It is transferred from those who believe the marketing reality to those who understand the forensic reality. It is transferred from the herd to the architects. Right now, you have the greatest luxury that the people of 1923 Berlin or 2018 Venezuela didn't have: time. You can see the price of bread is still normal.
You can see the ATMs are still working. You can see the lights are still on. But the forensics show that the foundation is cracking. Do not wait for the baker to pick up the chalk and write a number with 12 zeros on the board. Do not wait for the temporary suspension to become a permanent collapse. The goal of this channel is not to spread fear. Fear is a reaction. We are looking for a response. A response is calculated, calm, and strategic. By watching this video, you have already taken the first step. You have decided to look at the autopsy of the system before you become a part of it. Build your pillars, diversify your jurisdictions, invest in the real world, and most importantly, keep your eyes on the patterns.
The rules of money are being rewritten as we speak. You cannot stop the reset, but you can choose which side of the equation you want to be on. You can be a victim of the math, or you can be a student of the history. If you found this forensic analysis valuable, share it with one person you care about. The more people who understand these patterns, the more resilient our communities become. Subscribe to join our network of financial architects, where we continue to deconstruct the myths and build the reality of wealth. Thank you for spending this hour with me. The age of chaos is here, but for those who are prepared, it is also the age of opportunity. Stay vigilant, stay rational, and build something that lasts. I'll see you in the next investigation.